BinaryOptionsStrategy.com.
Hello, this is Daniel Grady with Binary Option Strategy, and today we're going to talk about divergency strategies. The basis of any divergency strategy is to use two indicators and look for differences or divergencies between them. They are really popular among professional traders who often personalize them for their particular trading style. It's a simple concept, but there are literally dozens of indicators you can combine in so many ways it will boggle your mind. But today we're going to cover the basics so you know how they work and you can even come up with your own. Let's start with the market. You already know that the trend is your friend, and here you can see that the market is going down. But even if the overall trend is downwards, the market keeps zigzagging along the way. The market tends to be a bit ADD and will run after anything shiny for a while before coming back to its original course. So these zigzags are always going to happen, and the key to a divergency trading is to identify them and use them to trade. The general idea is to use an indicator that tracks the long-term trend and play it off an indicator that tracks a shorter trend. Often traders will use two different indicators like MACD or momentum, but you can use the same indicator twice but in different time frames. To make this easier to understand, we're going to use a simple moving average as an example. Let's say it's a 1-minute chart. For the purposes of simplicity, let's say we want to track the hourly trend for this graph. You can use different times, but the point is to establish an indicator that will show us a relatively long-term trend. So we start by adding an SMI with a 60-minute period. Now we need a short-term indicator that will be more sensitive to the market. Let's use, say, 5 minutes, which is added here in blue. Now what we're looking for are the times when the blue line, or the 5-minute SMA, goes in the opposite direction as the long-term trend. This tells us that the market is going through a correction, and as long as it stays below the long-term average, that is the yellow line, it will correct and return to following the trend. The way you trade this strategy is to identify a divergency, then wait until the market finishes its correction and goes back to the trend. In this case, you'll see that when a candlestick closes beneath the blue line following a brief upturn. For example, here the market has been correcting for a few minutes, and then a candlestick closed beneath the SMA line. This was the beginning of a significant move downward. Notice that there are other times when the situation repeats. You can apply the same concept with other indicators. For example, my personal favorite is to play a CCI off an RSI. But we'll get into more indicators later. That's it for today. Thanks for watching and happy trading.